Let's talk about one of the most powerful tools in a Forex trader's arsenal, Fibonacci retracements. If you've been trading for a while, you've probably heard about them. And if you're new to Forex, this is something you absolutely want to learn. Because Fibonacci levels aren't just lines on a chart, they're psychological price points that a lot of traders watch. So when the price hits those levels, things happen. Reversals, continuations, breakouts. And today, I'm going to show you how to use Fibonacci retracements the right way. Now first, what are Fibonacci retracements? They're based on a sequence of numbers discovered by an Italian mathematician centuries ago. But don't worry, you don't need to do any math. Trading platforms like MetaTrader 4 make it easy. You just drag the tool from a recent swing high to a swing low or vice versa, and the key levels automatically appear. The most common ones are 23.6%, 38.2%, 50%, 61.8%, and 78.6%. These levels act like magnets for price, often signaling where the market might pause or reverse. But just slapping a Fibonacci tool on your chart isn't enough. The best method starts with identifying the trend. Is the market moving up or down? Are we trending or ranging? This is where most traders go wrong. They try to use retracements in a sideways market. That's a recipe for frustration. Instead, you want to use Fibonacci in clear trends. For example, if you see a strong bullish move, wait for a pullback. Then draw your fib from the low to the high. That gives you a map of potential support zones where price might bounce. But here's the secret. Don't rely on Fibonacci alone. Combine it with price action. Look for candles that show rejection or confirmation at the retracement levels. Bullish pin bars, engulfing candles, or even a confluence with previous support and resistance zones. This increases the probability that the level will hold. Another tip, watch volume or volatility indicators. If price pulls back to the 61.8% level on low volume and then spikes with momentum, that's your clue the market might be ready to continue the trend. You can also combine Fibonacci levels with trend lines. When a retracement level lines up with a trend line, it becomes a high probability area for entries. Now, what about entries and exits? Here's a clean approach. Wait for a pullback to the 38.2% or 61.8% level, depending on the trend strength. Set your stop loss just beyond the next retracement level, and target previous highs or lows for take profit. But if you want to simplify this process even more, this is where tools like the Apex Trend Indicator can help. I use the Apex Trend Indicator to confirm if a pair is still in a valid trend before drawing my Fibonacci retracement. It visually marks when trends change using colored lines blue for buy, orange for sell. That way, I know I'm placing my Fib tool in the right direction. It even gives non-repainting buy and sell signals that match perfectly with many Fibonacci setups. And since it scans multiple pairs and time frames, I don't waste time hunting for setups manually. The real power comes when the indicator confirms that the trend is strong, say a 70% success rate, and I see price pulling back to a 50% or 61.8% retracement. That's my green light to enter. It's fast, accurate, and helps me stay objective. No more second guessing. So, to recap, the best way to apply Fibonacci retracements is in trending markets, combined with price action, confluences like trend lines or support zones, and ideally confirmed with a reliable tool like the Apex Trend Indicator. It's about stacking probabilities in your favor. If you found this useful, hit that like button and consider subscribing to FX Limit. We're here to help you trade smarter, not harder. Until next time, trade safe and stay in the trend.